Well, a big hello and welcome to all of our Halcyon clients, and welcome to the first edition of the Halcyon Review for 2018. We trust that you had a fantastic Christmas and New Year, and the year started off really well for you all. Today I wanted to focus on the performance of the global share markets over 2017 and what we expect to see happen in 2018, what the performance drivers have been in the past 12 months, and in particular, what are the key benchmarks that we're watching and indicators that we're following, and why, to give us a bit of an insight as to what's going to happen in 2018. 2017 was a strong year for global share markets, with the Australian share market up around 11.8% for the year as detailed on this slide. Whilst in the US we saw a stellar return as measured by the S&P 500 of around 21.8% for the year. So what drove such above average returns over the past 12 months? Well, the key drivers were events in the US, which included the prospect of tax reform, which we saw President Trump sign into power late last year. We also saw a deregulation across the business sector, which effectively meant a lot of red tape was cut, making business much easier to do. And finally, we saw an improvement in the economic growth, particularly again in the US, where consumer spending was on the rise. The Australian share market underperformed relative to the US in 2017. And given the composition of our market, this is not surprising. As you can see from the list of the top 10 stocks on the Australian Stock Exchange, 4 are dominated by the major banks. We have 2 retailers and a telecommunications company, all of which in a broad sense are struggling to grow revenues and profitability in the domestic economy. The other 3 stocks, Macquarie, BHP and CSL, however, were outperformers due to their greater global business operations. The story of 2017 has continued into 2018, with the US share market maintaining the momentum as the driving forces of tax reform and business deregulation has led to many companies announcing a boost in capital expenditure and investment. In addition, good performance has seen greater inflows into the market, what we call the FOMO effect, or fear of missing out. The Australian share market is down around 0.2% for the calendar year to date, whilst the S&P 500 has generated a return of 6.2%, the best start to a calendar year since 1997. Again, market composition also helps explain why Australia has lagged, with tech and healthcare stocks being strong performers and together make up almost 40% of the US index versus just over 9% of the ASX 300. Whilst the returns of 2017 and into 2018 have been generally positive for investors, there are always going to be risks. As we know from experience, there's always and will be periods of volatility and negative returns. What has been so surprising is that over 2017, neither the Australian or US markets had a fall of 10% during the year. Indeed, the last meaningful fall in the US market was when it fell around 3% in late October in 2016, in the lead up to the US presidential election. By historical standards, this is very unusual. Major global share market indices are enjoying one of their longest ever winning streaks. To get some insight into the possible share market performance in 2018, the key benchmark we are watching is the US 10-year Treasury yield. This is a key global benchmark that determines the valuation of global assets, and it is on the rise as the prospect of an improving US economy increases and the potential of an increase in inflation and an increase in interest rate hikes as a result. Indeed, current consensus is that the US Federal Reserve will increase rates 2 to 3 times in 2018. So why is this so important? Well, all assets compete for investors' dollars, and when assessing the attractiveness of investing into shares, the income yield from shares needs to trade at a premium above the yield from bonds to compensate for the risk, as stocks carry a lot more risk than bonds. As US bond yield rise, you will see and hear plenty of stories and talk about rising interest rates and their impact on shares. The theory being as the 10-year yield rises, so does the risk of a sell down in shares. Remember, there is barely a week that goes by without someone warning of a new stock risk or an impending meltdown in share markets. After all, fear does sell. It is important to remember that volatility in share markets is normal and that pullbacks are not to be feared but seen as an opportunity to buy good quality assets at reduced prices. Global share markets have not given us this opportunity for well over 12 months now. Well, there you have it. If you would like any further information with any of the slides or discussions that we've just had in this review, please, by all means, contact any one of the Halcyon team. As you know, we always love to hear from you. Of course, if there's anything else that you want to be speaking with us about, don't hesitate to call. Here's hoping that 2018 is a prosperous year for us all, a fun year and a happy year, and that it brings everything that you want. Until next time, take care and bye for now.